All right, hey everybody, Matt Giles here, back with another market update. Less than a week into the conflict in Ukraine, and already the markets are digesting what the conflict could mean. Again, these views and opinions are secondary to the conflict taking place in Ukraine. While our primary job is to provide investment advice, we certainly recognize that there is an immediate humanitarian crisis out there, and our hearts go out to those impacted. So a couple months ago, we had uncertainties. Market doesn't like uncertainties around COVID and Omicron. We had the Fed rate hikes and the Fed reducing its balance sheet called quantitative tightening. We had inflation, it's midterm election year, let's not forget, and maybe even some whispers about the Russian-Ukraine conflict. This is all on the surface. We all see these things, but there was actually a lot of stuff happening beneath the surface of the market as well that's a bit beyond this video, but for short, let's just call it asset flows. Asset flows have a really big impact on markets. So we had all this stuff going on, and that's usually how these market events come together. This, and this, and this, and this. When all these items are uncertainties, they can act as headwinds or challenges for the market. When these uncertainties resolve, the headwinds can actually turn into tailwinds that support the market. Look at expectations for a Fed rate hike at the March meeting. This is a public website called the CME FedWatch tool. You can go there. Blue line is no hike. Orange line is one hike and green line is two hikes. So it was one hike throughout December and January, then into early February, almost guaranteed for two hikes. Look at that green line spike up. And now virtually guaranteed back to just one hike. This is what we've been talking about for a while. The Fed is buying time for other events to do some heavy lifting so it doesn't have to make such drastic hiking decisions itself. Two Fed rate hikes plus all the other stuff, headwind. Just one hike and perhaps a little clarity, albeit still tragic, regarding Ukraine's resilience and the international support, could turn into a tailwind. If you try to predict or, heaven forbid, trade this thing, you'll drive yourself crazy. That's why we're always recommending to fade these month-to-month news items that are frankly out of our control anyway, and zoom way out. What does this look like in 6 months or a year? And before we start talking about how bloated the Fed's balance sheet is, look at this. Central bank balance sheet to GDP. Now, usually we see federal debt to GDP, but the balance sheet includes assets too, which is part of the equation. You don't just consider your mortgage, you also include your home equity, right? So full balance sheet of central banks to GDP. Quite remarkable to see our very own Federal Reserve at just a fraction of other developed countries. Now, tailwinds can become headwinds too. Government transfer payments saved the day during COVID. Now those are largely finished and we're getting back to pre-pandemic government transfer payment levels. As we've talked about over the past few months, the real economy is going to have to step up and do some heavy lifting here. As we're settling into the realities of the Russia-Ukraine conflict, here are some other items to keep in mind. Last week, the S&P 500 index officially moved into a correction of 10% for the first time since March of 2020. Since 1950, there's been an average of 10% correction per year. So there we have it. Midterm election years tend to be among the most volatile out of the 4-year presidential cycle. In fact, the average midterm year sees a peak to trough pullback of 17.1%. But stocks are up more than 30% off the lows on average a year later. Currently, earnings are strong. And while strong earnings are better than weak earnings, these earnings reports are in the past. Earnings growth, and whether that growth is accelerating or slowing, drives the market. We do not see a recession over the next few quarters, but do expect slowing earnings growth and potentially slowing GDP growth as well. There are likely better times ahead in 2022, even if that means sitting and waiting for months. We are reiterating our position that now is not the time to be making dramatic moves regarding your investments. We don't want to be heroes. We want to be your steady, long-term partner. That includes times like these where the markets can meander and grind away, and we'll keep our focus not on the days and weeks, but on the months and years ahead. In the meantime, we are in tax season. Gathering all your documents can be a drag. So if you'd like us to prepare and deliver all your tax documents to your CPA or tax preparer, we are glad to do that for you. Please keep in mind, we can only gather the tax documents for your investment accounts we oversee. If that is of interest, simply respond to this email and say, please send tax documents for me. We will get in touch with you to get your CPA's contact info. Then we'll send you a DocuSign authorizing us to send documents on your behalf. Thanks very much. See you next time.